Hello friends, welcome. Friends, if you recall, just 13 days back, I did this video which spoke about how much would be the VI's market cap rise if the government waives of dues. Now, in this video, I try to explain to you many concepts, which are the cost of equity, cost of debt, this is the cost of debt, cost of equity, and then cost of capital. And then I took you through my sheet for calculating the enterprise value. And then I subtracted all this debt and then calculated the equity value. And then I said that the current market price and the debt, if there is going to be any relaxation by the Government of India in terms of waiver of debt, is not a linear relationship. People might be recollecting my video. In this video, friends, I could not explain to you the concepts because the corporate finance is a very complex topic. Now, today's video, I am trying to dissect the concepts of corporate finance, which I have used in this video to explain why any waiver of debt is not going to increase the market cap of Vodafone linearly. Using this video so that you understand that how this whole mechanics worked, what I showed you in this video. So friends, without wasting any further time, we are going to start with the concept of valuation. Because friends, when I was doing this video, people were sending me a lot of messages and they were confused, which I could understand, because people are talking about a mixing accounting valuation with the cash flow valuation. And then, there are a lot of nuances which are being thrown at me. I ignored some of them, tried to answer some of them. And I thought that I will use this video to give you the intuitive understanding as to how valuation works. So it's a corporate finance course zipped into 20 to 25 minutes. So be with me. You will get a very good concept about intuitive concept about valuation. And all this concept you can read from various books and internet, but you will get terribly confused. And that is the reason, friends, I'm doing this video to explain to you in very simple terms. Now, friends, what is valuation? In simple terms, not a Wikipedia definition on corporate finance definition. I'm going to give you a very simple definition. You have got certain assets which you procure from the cash that the investors lend you. Equity investors and debt investors. Somebody has to invest in company. Without investment, you will not be able to generate any cash assets. Those assets are bought from the market or acquired from the market. And those assets are generating cash. And these cash are in the future. And these are uncertain cash. So these cash flows, when you discount using a discount factor, which we are going to discuss as we move forward, that is going to result in valuation. Now, we are going to talk about two investor classes. One is the debt investor class, another is the equity investor class. And for both the investor class, their value of those assets are going to be different because they carry different risk. Because all the discount factor that we are talking about, that discount factor is a reflection of risk that they carry, and why they carry risk, we are going to talk about, right? Now, before we talk about and go into the next slide, first we have to say, or you have to clarify this, that debt investor gets their right of accessing this future cash flow first compared to the equity investor. And therefore, a debt investor will carry different risk compared to a lower risk compared to equity investors. Now, friends, accounting valuation versus intrinsic valuation. Accounting valuation means the book value and the depreciation that keeps on happening, and then the book value will keep on depreciating. That's just a framework to give some idea so that every company who reports their earnings, everybody doesn't have to do intrinsic valuation. They can look at the book value and make some kind of judgment, how the company is performing. But accounting valuation is not a reflection of intrinsic valuation, for which you need to do present value of future cash flow. As simple as that. Okay. So you have all these assets, and these assets are working together to generate cash flow. Now, friends, there is going to be a misconception here. People will say that we should dissect these assets and then add the value of this asset. That should also give us the same kind of cash evaluation or same kind of cash flow. No. Let me give you an example, friends. Telecom companies. What is asset for telecom companies? Spectrum, license, major assets, and then we have got base stations. and maybe tower, building, etc. But the main assets is spectrum and license. Can you liquidate spectrum? Can you liquidate license? You can't, because DOT will not allow you to liquidate. Therefore, even though these assets are reflecting some value in the books, but if you are going to extract this asset when you get bankrupt and try to sell this asset, normal time you can sell, because trading is allowed. But if you get bankrupt and try to sell this asset without paying dues of DOT, your assets will have zero value. That is why, friends, asset per se or dissected out from this collective framework which I'm showing you, sometime will have zero value. So this collective framework is very, very important for you to generate cash flow. You understand now? That is why you should not ever go and start valuing asset in a standalone manner. It may give you high value, it can give you zero value also, right? Now, what is risk and return, discount rate? Now, friend, here I would like to explain to you a concept which people generally miss out in any corporate finance class. What is that? The point which I want to make is that, let's say if you find a certain stock trading in the market in a certain value, who decides the price of that stock? Do you? Do I? No, because we are minuscule compared to the value that or the power that an institutional investors have in the market. They decide the price of stock because they control the market, because they trade maximum volumes and money. So you will find that all risk and return models that we use in the market, the metric that we use, the discount factor that we use, are primarily mapped to the institutional investors. The value of those numbers are primarily mapped to the institutional investors, not for the retail investor, because every retail investor will have a different risk appetite and the risk that he will see in the market. You can't map those risks together, but you have to play in the market, in the same market in which the institutional investor is playing, and therefore the value of those assets are going to be driven by the institutional investor. You are not detached from that reality, right? So what this discount rates, which is cost of debt and cost of equity, which we are going to discuss going forward in this video, first thing to understand is these are determined by an institutional investor who is well diversified. He is diversified into every asset class, and he or she will calculate the discount rates based on the risks that he is putting on his head over the various asset class he or she has invested. Because every asset class is not going to give him or give his company or his company a guaranteed return. Somewhere he will lose, somewhere he is going to gain, right? So therefore, he should be making a profit which will be an aggregated number of all these investments so that he can stay afloat. That's how the risk is determined in the market, both cost of debt and cost of equity. Okay. So higher the discount rate. So if you have got discount rate which is high, then your present value of the asset is going to be lower. Lower the discount rate, higher the present value. Because why? Because a present value of any assets which you map it in cash in rupee terms or dollar terms is a reflection of what certainty those cash flows in future is going to come. So if you find your cash flows in the future is uncertain, then you are going to give a lower value to that asset, which means that you have to do a higher discount rate. You got it? So if your cash flows are certain, then your discount rate is going to be low and your present value of those assets are going to be high. Do you understand now, right? This is a simple concept. Now, how cost of debt is calculated? So friends, in order for you to calculate cost of debt, you first have to make some reference, because as an investor, I will always be more driven or more motivated to invest in asset class which are less risky. So what is the least risky asset class in India? Though the returns are going to be low, but what is the least risky asset class? It is basically Government of India bonds. not the low duration bonds, but the bonds which are of higher duration, 10 years. Now, why higher duration? Why not low duration? Because the low duration bonds are influenced by the RBI's interest rates. So, if you have an RBI interest rate set high or low, then the low duration bonds yields are going to be driven by that, because you have an option to invest in RBI, and therefore, if anybody demands higher yield in the market, that yield is going to get depressed because of an alternative that investor has to invest in RBI's bonds, low duration bonds. But high duration bonds of 10 years, 15 years, those are not determined by RBI rates, because those are determined by what? Expected inflation. Because even if you have a reduced interest rates from RBI, and if the market sees a higher inflation rate in future, you will find your 10-year bond rates are going to be trading at a high yield, right? So therefore, whenever you are calculating cost of debt, you have to take those bonds which are of longer duration to able to calculate the risk-free rate, because the company's valuation is not for short term, it is for a long term, it's for perpetuity, and therefore you take long-term bonds. And for Government of India bonds, let's assume that they are trading at 8%. I'm just making up. They are actually trading at 6.5 or 6.6%. That is going to be the risk-free rate. And then in that risk-free rate, friends, I'm actually calculating cost of debt. And therefore, I'm not bifurcating that risk-free rate into two different compartments. There are two different compartments. One is that risk netted out of country default spread. What is country default spread? If the Government of India is issuing a bond which is trading at, let's say, 8%, there will be other country like US, their bonds may be trading at 5% or 4%. Why those bonds are trading at lower rate? Because that country has got a higher rating. It has got a lower inflation. You got it? So therefore, in India's bond, let's say if it's trading at 8%, the 2% country default spread, depending upon the rating agency, is going to become part of that risk-free rate. So it gets added. And then on top of it, there is called a corporate default spread. What is corporate default spread? Let's say if you have a company which is going to be on top of India, it is running in India. So India has got certain default spread. Now you are not investing in the Government of India bond, you are investing in the company's bond. You need to take care of a higher risk of investing in that company, which may not be so secure. So you need a higher cost of debt, because the company may not be able to pay you those cash flows in the future, because its EBITDA may not be higher enough to be able to generate cash for paying the interest to the debt holder. So the interest coverage ratio, which is reflection of how much EBITDA that company is generating, is a clear reflection of its default spread, which is added to the risk-free rate to come out with the cost of debt. You understand now? Now, this is from an investor point of view. But from a company point of view, this is going to be lowered by the 1 minus tax rate. You have to multiply that. Why? Because any interest that company has to pay to the debt holder, that the company gets a certain discount from the government, because it gets netted out from the cash flow from the point of view of tax calculation. So from a company point of view, the discount rates are going to be lower, right? That is why this after-tax cost of debt is be netted out from the tax rates. So we already spoken about rating, leverage, coverage ratios, etc. Now, why cost of debt is adjusted in tax, which I have already explained. From an investor point of view, it is going to be the same coupon rate. From a company point of view, because company has got a pool of cash. That pool of cash goes to the equity holder and to the debt holder. Now, if company is able to save some taxes because he's paying interest, therefore, its pool of cash is going to have more flexibility to pay interest to the debt holder and the equity holder. And therefore, from a company point of view, the taxes are adjusted from the point of view of calculating cost of capital, which is a weighted average of the cost of equity and cost of debt, right? Now, cost of equity, how do you calculate cost of equity? Because as I told you, the equity holder will have a lower pedestal claim on the future cash flow of the company. So what happens is, friends, whenever an equity holder tries to calculate his overall risk of the company, he will start with the risk-free rate. And what is the risk-free rate? Here, the risk-free rate is going to be the rate which is the corporate bond rate, the country bond rate, the Government of India bond rate, 8%, and the default risk of India, which is 2%. So you multiply minus 8% minus 2%, 6%. I'm just throwing a number. It can be, numbers can be different. So that is the risk-free rate. And forget about beta for the time being. Then there is a concept called equity risk premium. Now, you normally would have invested in a risk-free rate and you would have expected a risk-free return. But since you are investing in equity, you have to look into the basket of all equities in the market, which is well diversified. Means an investor, institutional investor is well diversified, and that basket is being seen as the Sensex. So let's say if you have a Sensex where all kind of stocks are there, very well diversified, you will see that how the Sensex is performing from the point of view of return. And then how your company is performing from the point of view of that Sensex. Now, we will talk about how the company is performing from the point of view of Sensex, but let's look at the Sensex performing from the point of return. Now, you might have seen sometimes the Sensex performs pretty well, sometimes the Sensex performs pretty bad. So it is driven by what? The investor sentiment. And the investor sentiment can be calculated by the return that this Sensex is giving from any point of time in form of dividend, in form of buybacks. So that is the equity risk premium, which will keep changing over time. Now, since the company can be more volatile because their returns cannot be guarantees compared to the Sensex, it can be going like this, company's return. So since the company may have more volatility compared to the Sensex, so that volatility of the company compared to the Sensex is measured in terms of beta. So if the company has got same volatility as the Sensex, means if there is a direct correlation, then the beta is 1. If the company has got less volatility compared to the Sensex, this is a straight line I'm showing. Generally, Sensex will not be like this. It will be always like this, go up and down. So if the company is also showing the same curve, it is beta is 1. But if the company has got less volatility, then the beta is less than 1. And if the company has got higher volatility compared to the Sensex, because you don't know when you are going to exit the market, you may end up, choosing the bottom when the valuation is at the latest, the market price is is at the bottom. So therefore, the higher the beta, more will be the cost of equity, means that company is highly leveraged and their returns are not certain. You don't know what return you're going to get when you need money. So therefore, the equity cost of equity will be risk-free rate, plus beta multiplied by equity risk premium. All right? Okay. Now, what is levered beta and unlevered beta? This is important, friends. The levered beta is that how much the company is levered, means how much debt that company is holding. If a company has got zero debt, then in that particular case, whatever the beta that you see here, which I spoke about here, it will be industry specific. Means a telecom industry will have a different beta, the oil industry will have a different beta, pharmaceutical industry will have a different beta, because the pricing leverage industry has depends upon the macroeconomic condition of the market. You may not have pricing leverage. You may not have, just like luxury company who deals with luxury goods. And if there is a time of, let's say, macroeconomic condition of the country is strained, then the company is not going to perform very, very good, right? Because people may not buy those luxury goods. Therefore, the beta is a reflection of sector. Now, on top of which, if a company is highly levered, means it is carrying more debt, then the risk that company carries on top of its head is going to be higher, because the debt holder is going to demand cash flow. The cash flow of the company will be demanded by the debt holder first, because the debt holder doesn't care whether the company is performing well or bad. Therefore, the company's volatility as far as the equity price is concerned is going to be pretty high, depending upon how much levered that company is. And therefore, the levered beta is a reflection of that debt to equity ratio. You understand now? Therefore, whenever you are calculating, you are using the capping model. Here you are using levered beta. You are not using the unlevered beta. Okay. Now, which we already spoke about, right? It amplifies the risk. Then we have got two types of cash flow. One is called cash flow to the firm, another is called cash flow to the equity. Now, what is the difference? Which we already spoke about in this video. This video is actually has a very clear understanding, or I gave you this example. So, how do I calculate cash flow to equity, cash flow to the firm, and cash flow to the equity holder? Now, you know that we have gross revenue here. This is the example of Vodafone Idea. Then we have the OPEX cost. And when you subtract from the gross revenue the OPEX cost, you get the EBITDA. Everybody knows that. Now, in the EBITDA, what you do, you subtract depreciating amortization, which is a non-cash item, and then you come out with EBIT. So instead of using EBIT, you can start with EBITDA directly. Because EBITDA is the cash that you're getting, which is a reflection of the amount that you finally have to pay to what? Your equity holder as well as debt holder. Now here, you need to do some mandatory deduction because interest and finance cost is you are paying to your debt holder, but you are doing capex anyway. Whether you pay to the equity holder or not, capex you have to do anyway. So what you typically you do is either you start with EBITDA or you start with EBIT, add the depreciation amortization, and then from there you basically subtract the capex. Once you subtract the capex, then you get the cash flow to the firm here, the cash flow to the firm. And that cash flow to the firm will contain the cash will be demanded by the equity holder as well as debt holder, with a caveat that here you have to take into consideration certain deduction that you get from taxes as well, because your tax is going to be also be paid. You have to subtract taxes, and that tax is going to be the reflection of how much interest that you have to pay. So that has to be netted out. So this is for just the purpose of indication, but if you have to do a refined model, it is going to change based on those caveats which I have already explained. So once you have got the free cash flow to the enterprise, and you know that what is the weighted cost of capital, which is the cost of debt and cost of equity, in a weighted form, the cost of capital you can calculate. Then you discount those cash flow by using the weighted cost of capital. That is going to give you the enterprise value. And then if you want to calculate cost of equity, then you have to subtract these items. You have to start from the profit, profit before tax. And then you have to do the same thing which I told you, add the DNA, the capex, etc., subtract the capex, and then certain items which I have already, ignored. For example, what is that? The working capital, etc. Those I have been, just ignored for the time being. And then that is going to give you the cost of equity, the equity valuation to the company, right? So what is this? Which discount rate to use for cash flow to the free cash flow to the firm? You have to use the weighted average, cost of capital, which is this. The total value of the company, equity plus debt. Then you divide by equity, means how much is the equity value and how much is the debt value. That is going to be the cost of capital, and use the discount rate, and you calculate the cost flow, right? Then we have got the terminal value. Now this is very important, friends. So here in this video, I try to explain what terminal value is, because what I did I do here, I took the free cash flow of the firm, and then I calculated all the cash flows here, and then I discounted this using the cost of capital, right, which is the weighted average cost of capital of the cost of debt and cost of equity. Then I need a terminal value. Why terminal value is so important? Because you have to have this cash flow to perpetuity. Now I could have assumed a certain mature growth, certain growth rate of 15% forever, but the companies do not have a sustained growth rate of 15% on revenues. It may happen after certain times the company will become mature, then their future growth rate is going to become lower than 15%. It will be at par with the GDP growth of the company. So then you have to do what? You have to take that valuation using a different growth rate of 6% and assume that this is going to be a perpetual cash flow, and then calculate the terminal value, and that terminal value will be discounted by this discount rate to calculate the enterprise value. And then from this enterprise value, you subtract the cost of debt, cost of government debt, private debt, and the lease liability, which I told you in that video. Lease liability now at the bottom of the line. If you see here, leases were earlier taken within the EBITDA. Now they have extracted and put it in with the interest, right? Because it acts almost like debt. and then you get the terminal value. Once you have the terminal value, using the terminal value, you can calculate your enterprise value, which you can clearly see here. It is the addition of everything here, right? Okay. So that's all, friends. Other than that, I don't want anything to discuss here. So this is what I wanted to do to make you understand how this whole corporate finance structure works and how it can be mapped to the video that I did here, which gave the non-linear relationship between the current market cap and the increase in value because of the waiver of government debt, which I could not explain in that video. I thought I will explain in this video. So if you see this video and then using this, after having looked at this video, if you can, watch this video, you will get a very good understanding as to what is going on, and that it will clear a lot of your concept. So thanks for listening to the end, friends, and I'll come back with a new video and a new topic next time. Thank you very much, friends.